One of the common themes I have observed in managing investment funds is that the wealthiest Americans tend to invest differently than individual investors. As we began studying how America's wealthiest families invest, it was quickly apparent that they invest similar to large endowments and insurance companies. These groups invest only a portion of their assets in traditional stocks and bonds. Wealthy investors grew tired of having all their assets tied to the daily volatility and emotional investing of the capital markets. Daily fluctuation of stocks and bonds fatigued investors and raised concerns about the stability of capital markets. In addition, markets seemed to be moving in the same general direction, but by different measures of magnitude. The story of diversification among equities seemed to feel more like diversification. For example, if it was a good day in the market for U.S. equities, it was likely a good day for foreign equities as well. And vice versa. If it was a down day for the U.S. equities, it was likely a down day for foreign equities. Sophisticated investors began blending less liquid assets like real estate, private equity, and private debt with daily marketable securities like the S&P 500 index. This created far more stability to the portfolio, and values didn't fluctuate on a daily basis based on what was happening with the news or the psychology of the market. There are some additional benefits to blending these strategies as well, as it offers varying liquidity, short-term and long-term investments, and may generate high levels of cash flow and provide long-term performance without the day-to-day fluctuations of the equity market. As an investment manager, I was frustrated with the large banks and the investment firms' unwillingness to offer these types of strategies to our clients. There are several reasons why your investment manager does not offer these strategies to you, but it typically boils down to the added work and effort it requires to make these investments available to thousands of clients. Their size is the biggest problem in personalizing your portfolio. Your investment manager does not want you to take money out of your investment portfolio and invest in a building or a private debt strategy. They want you to keep their money locked up with them. As we begin studying some of the country's wealthiest families and most successful endowments, investors like Harvard and Yale, it was obvious those firms do not invest like the typical investor. A recent study suggests that these wealthy investors tend to share common portfolio characteristics. They are as follows. 1, wealthy investors tend to invest in what they know. 2, they tend to invest in tangible assets like real estate, farmland, apartment buildings. 3, they diversify into different types of real estate and private equity assets. 4, their portfolio consists of more than just stocks and bonds. And 5, they tend to use an investment manager to help direct their assets. We started Approach Capital to help individual investor gain access to some of the country's best investment managers. We believe that the typical stock and bond portfolio is outdated and fails to meet most investors' long-term objectives. Why buy a large portfolio of bonds when interest rates are at an all-time low? There are other assets that you can buy that will increase your cash flow, but most investment advisors are unwilling to consider such strategies and are unable to share them with you. Why the investment model, or why the enhanced investment model? Many investors embrace the idea of putting money to work in assets that are more tangible and income producing. Investors like owning apartment buildings, office building, real estate, and buying into private companies. By adding these types of assets beyond just stocks and bonds, the enhanced strategy aims to decrease portfolio correlation with equities while maintaining strong portfolio performance. In a world of historically low interest rates and low bond yields, real assets such as apartment buildings, commercial investments, properties, and private equity leases may offer far more attractive returns. In addition, these assets may be an excellent hedge against inflation. The world has changed. The idea of owning a pool of mutual funds, index funds, and some bonds is hardly a diversified portfolio. The retail investor that has only those simple tools to construct a portfolio is not offering you true diversification. It's not enough to diversify your equity holdings by adding U.S. and foreign assets. That is just adding more of the same and hoping for diversification. Approach Capital's enhanced investment model is designed for investors with $500,000 in assets or more. Our portfolios consist of roughly the following allocation and may be modified to meet your individual objectives. What does our portfolio look like, you say? Well, 33% stocks, 33% fixed income, and 33% alternatives. Or a portion in equities, a portion in fixed income, and a portion in alternative assets and hard assets. Our investment approach utilizes the traditional capital markets and standard assets like the S&P 500, foreign equities, and bonds. Most investors are familiar with this type of approach. However, the investment model becomes significantly more diversified by employing other hard assets that may be less liquid investors that may be less liquid investment strategies. These strategies include hard assets like private real estate, commercial buildings, private debt structures, and private equity. As the stock market has inherent daily volatility, assets like large commercial buildings don't fluctuate in value on a daily basis. We like these types of assets for our clients because they offer relatively dependable income streams, a fixed rate of return, and may be a good hedge against inflation. In addition, a high-quality office building isn't likely to come under tremendous pressure should we move into a recession. High-quality office buildings typically have long-term leases with healthy businesses, which are not likely to have dramatic staffing needs in a downturn. Many people ask me, how do we invest in this model? Well, by leveraging our size, our access, and our experience, Approach Capital Partners can help you cost-effectively invest in the enhanced investment model. Our size allows the individual investor to spread their wealth across many different asset classes. You don't need to concentrate your wealth in one building or in one particular market. Rather, we suggest a fund approach where your assets are diversified across various markets and types of assets. Approach Capital's enhanced investment portfolio is a blend between the much publicized endowment model made popular by institutions such as Harvard and Yale's endowments and the traditional retail investor strategy of a balanced stock and bond portfolio. The common thing amongst investment strategies is the use of non-standard assets. Non-standard assets include commercial building, private real estate, and private debt. Endowments, retirement plans, and pension funds have promoted the use of alternative assets as a complement to the traditional retail stock and bond model. These large firms have embraced diversification, and by adding additional asset classes to the portfolios, including commercial real estate, private equity, and private debt. Retail institutions like brokerage houses and banks have been reluctant to embrace these alternative assets or have been only made available to their wealthiest clients. By leveraging our size, our access, and our experience, Approach Capital Partners can help you cost-effectively invest similar to the Harvard and Yale endowment model. The objective is to invest in many different types of assets. Some of the assets we employ trade on a daily basis, and other assets are designed to generate income and growth. For example, a commercial building or an apartment building. These income and growth assets may be long-term and more dependable upon rental income than, say, a corporate debt payment. We'd love to hear more from you. Please click on the link below if you'd like to subscribe to our mailer.